To get to the work together for 2.2, just like we did in the first one, you're going to go to end of lesson review under lesson 2.2, click on your working papers, and then click on work together. So in here, I wanted to show you that here is going to be some of the information that you're going to need. When you have this big box up here, you can resize it by coming to these little lines down here in the bottom right-hand corner and clicking. And then if you want to move that so that you don't have to continue to scroll up and down, the little push pin, if you click that, it now allows you to move that. Be sure not to put it up here and drop it because it'll get stuck and you got to get out of it and get back into it. I don't know, it's a quirk of the program. But you can move that around. It just makes it a little bit easier to see your transactions and your account titles that you're going to be working with. So what we're going to do here is we're going to be doing T accounts for each of these transactions. And you're going to have 2 T accounts, one for each account. So on March 1st, it says receive cash from owner as an investment. So when we analyze these accounts, the 2 accounts we're going to be impacted are cash and then our owner's capital account. And if you need to look back over here at the account titles, you can do that. And you see we have John Jensen Capital and cash. So we're going to put our debit on the first T account, and our debit is going to be cash because cash is an asset. Cash goes up with a debit. And so our debit is going to be $4,000 to cash. And so as we're learning, every transaction has to have a debit, every transaction has to have a credit. So since we have our debit to cash, we know that our other account, which we decided is the John Jensen Capital, is going to be credited. Now going back to the increase and decrease, capital is on the right-hand side of the accounting equation, so it goes up on the right-hand side. Credit means right. So capital is increasing. Cash is a debit on the left-hand side of the accounting equation, so it will go up on the left, which is debit. And so cash goes up. So since our assets are going up and our equity is going up, our accounting equation will still be in balance. The next transaction, we paid cash for supplies. So on that transaction, you're going to have cash and supplies. One is going to go up, one is going to go down. They are both assets. The one that is going up is going to go up with a debit, and that is supplies. And then cash is going down because we paid cash. So cash, since it's an asset and assets increase on the left-hand side, they decrease on the right-hand side. So supplies goes up with the debit and cash goes down with a credit. The next transaction, bought supplies on account from Supply Depot. We're going to have supplies and accounts payable Supply Depot. Both are going to increase. Supplies is an asset, so it goes up with a debit. Accounts payable Supply Depot is a liability. We now owe them $120. It goes up with a credit because it falls on the right-hand side of the accounting equation. On the 6th, paid cash for insurance. So this one's similar to our paid cash for supplies because cash and prepaid insurance are both assets. So prepaid insurance, the debit is going to go first. Increases with the debit. Cash is going to go down because we paid cash. It goes down with a credit. And the last one, paid cash on account to Supply Depot. Up here, we went and bought supplies. We owe Supply Depot money. Now we're going to make a payment to them. So Supply Depot is going to go down because what we owe them is going to go down. So it's going to be a debit of 80. And our cash is going to go down also with a credit. So both go, this is a liability, it goes down, asset, it goes down, our accounting equation is still in balance.